In this video, I discuss 4 ways you could accidentally lose your Social Security benefits. Coming up next on Holy Schmidt.
Holy Schmidt!
We work hard for 30, 40, some of us even 50 years to plan for the day where we step off the assembly line, walk out of the office, etc., and go into retirement. But unknowingly, there are certain situations which will cause what we expected to get from Social Security to be reduced, maybe even eliminated if you're not careful. This video will discuss what those 4 ways are and how you can protect yourself against those ways. Now let's get into it. But before we do, please make sure you click subscribe and notifications so that you get alerted the next time I post a video. I post about twice a week. All right, point number 1 is blowing through your earnings limit. A lot of people think that once they reach the age to draw Social Security, they don't need to think about whether or not they continue to work. They've paid the money into the system. They've done the 30, 35, 40 years, as I mentioned before, and now it's their turn. This is understandable because the fine print isn't posted on your check every 2 weeks or every month when they take out your Social Security tax. And so therefore, you just look at what you've been paying in and assume you're going to get some or all of that back. The earnings limit is one of the top negative Social Security surprises. And so this is why it's the first of the points I'm going to talk about. Let's talk about what the earnings limit is and what it means. Earnings, by definition, means something that you get from your job or if you're self-employed from your business. If you're still working when you draw Social Security, or if you're still self-employed when you draw Social Security, the Social Security Administration will calculate what's called an earnings limit adjustment. They use earnings limits based on one of 2 calculations. If you have not reached your full retirement age, or if you are in your full retirement age year. And the number that they give you and the reduction that they reduce your payment by is different depending on which of those 2 buckets you fall in, so to speak. In 2022, the non-full retirement age limit is $19,560. For every $2 you earn over that amount, you have to give $1 back to the Social Security Administration. Theoretically, you get it later, but it doesn't change the fact that your cash flow is less today than you were expecting. Now let me walk you through an example to show you what happens in the non-full retirement age year. If you earn $56,680, that's the average income of someone in this country, that equates to $4,723 per month. The 2022 earnings limit is $19,560. This equates to $1,630 per month. And the average Social Security payment for 2022 is forecasted to be $1,657 per month. Those are 3 very important numbers. And if you understand what these 3 numbers are, the rest of this is quite easy to calculate. Let's assume you continue to work full-time. You have $4,723 of income coming in. You have an earnings limit of $1,630 per month. So the net overage is $3,093. That's $3,093 more than the Social Security Administration allows you to earn without a clawback or a reduction. So if you earn $3,093 more than the earnings limit, and you are required to give back $1 for every $2 over that amount, that means that you simply divide $3,093 by 2. That's $1,547 per month that you have to give back to the Social Security Administration. Unfortunately, if you receive the average payment of $1,657, you have a net inflow of $110 per month after the give back to the SSA. If this is the year that you reach full retirement age, for conversation's sake, let's say that's age 67, it will be somewhere between 66 and 67 for everyone watching this video, then the earnings limit is $51,960. And in that scenario, you have to give back $3 for every dollar over that amount that you earn. Once you reach full retirement age, you don't have to give back anything. So you can both work full-time and draw full Social Security, and you'll be just fine. Point number 2 is claiming Social Security too early. There are 3 numbers that you need to know: 70%, 100%, and 124%. And those 3 numbers correspond to the amount of Social Security payment you get at different ages. At age 62, you get 70% of the payment you're due at full retirement age. At full retirement age, 66 or 67, or somewhere in between, depending on your particular situation, you get 100% of what you're due at full retirement age, of course. And if you wait until age 70, you get 124% of what you would have received had you taken Social Security at full retirement age. The fact is, almost half of these Social Security recipients take Social Security at age 62. Now, why do they do that if the difference between a payment at 62 and a payment at 70 is almost double? Well, there are a lot of reasons. Some of them make great sense, like health reasons, or you just want to travel and you have plenty of money. But other reasons are a little bit harder to understand. The one that's most common is, I've waited, I'm due, I'm taking it. This usually happens in the same conversation as someone who said, I've worked X number of years my entire adult life, and I'm not working another day at my job. And then the next reason is the no reason, as I call it, which is, seems like a good time, I don't really have a reason why, so I'm just going to take it now. That person doesn't understand 70, 100, 124, and the meaning behind those numbers. So just remember, Social Security has a progressive payment structure. The longer you wait, the larger your payment, but the less payments you get, obviously. By the way, for those of you who still aren't sure about which way to go, I have videos which will help you with that. I'll put a link at the end to one of them, and that'll help you figure out whether 62, 70, or somewhere in between is the right age for you. Point number 3 is a legal offset, debt that you owe someone else. We've all heard somewhere that Social Security payments are sacrosanct. They are untouchable by creditors. For the most part, this is true. Doctors and hospitals can't go after your Social Security payment, nor can your credit card company. If they could, there would be a lot more retirees living on the street, because sometimes the Social Security payment is the only thing that's standing between them and something really bad. But retirees are not bulletproof in this regard. Just because you are receiving a Social Security payment doesn't mean that your payment can't get garnished under certain circumstances. It's rare, but it can happen. Classic example is government debt, the IRS, the Small Business Administration, student loan debt. All 3 of those are very good examples of where the government can go in and garnish your Social Security payment. Then there's non-government debt, which can also pierce the protections that you would normally have. Child support and alimony are 2 that come to mind immediately. And the last one is victim restitution. If a court deems that you've committed a crime and there's restitution due to the victims, well, your Social Security payment can be used to pay those victims. Outside of those scenarios, or situations similar to those scenarios, you're not going to have to give up part of your Social Security payment to someone else. The last one is one that catches a lot of people off guard, and that's taxes on Social Security. That's because there are a lot of different rules for Social Security, and people often confuse taxes on Social Security and the rules around taxes on Social Security with the rules around income limits or earnings limits that we talked about in point number 1. In point number 1, I noted that there was a threshold, $19,560 during a non-full retirement age year, or $51,960 in your full retirement age year. If you earn above these amounts from your job, you'll have to give part of the excess back to the SSA, at least for now. But in those situations, the SSA doesn't touch your Social Security payment if you're drawing from your 401k or your IRA or your pension, because each one of those is a responsible, at least deemed to be responsible by the SSA method to plan for your retirement, and they don't want to dissuade people from protecting themselves as they go into retirement. There's a certain logic to that, of course. If you've spent the last 35 or 40 years scrimping, saving, working really hard to get money into a retirement vehicle, only to have the Social Security payment taken away because you did that, well, that doesn't seem very fair. And you would have a lot of people that didn't save for retirement if that was in fact the case. On the flip side, you sort of remember that on your paycheck, your FICA contribution was made with after-tax dollars. At least your portion was. You didn't get a tax break when you paid into FICA, much like you don't get a tax break when you pay into a Roth IRA or 401k. To many people, this sort of signals that you're going to receive your Social Security payment tax-free because you paid in with after-tax dollars. Now the day comes when you're officially in retirement. You walk out of the building that you've worked at for the last 30 or 40 years and you head off into your great adventure, the one that you've been waiting for since you started working way back when. You're safe because you abided by the rules of Social Security. You don't have any clawback coming because you aren't receiving a paycheck, or in the case of owning your own business, you've shuttered the business and you're no longer in the business. But April 15th comes around and your accountant or your tax software, depending on which way you're going, tells you that you owe money on your 401k contributions. That's okay because you paid into your 401k with pre-tax dollars, you got the tax benefit. But your tax software also says that you owe taxes on a portion of your Social Security. So what happened? Well, in a nutshell, the government uses a different set of rules for taxes on Social Security than it does earnings while you're drawing Social Security. The government doesn't use earned income threshold for taxes. It uses something called combined income. Combined income is basically your adjusted gross income. So this is income from your 401k, your IRA, earnings if you had earnings from a job, etc., plus municipal bond interest, plus 1/2 of your Social Security payment. If that combination equals $25,000 or more, then the excess is taxable. That's if you're single. If you're married, the threshold is $32,000 of combined income or more. Again, any amount above that is taxable. If you like this video and you want to see more of me, please make sure you click subscribe and turn on notifications so that you get alerted the next time I post a video. There's a lot going on with Social Security right now. A lot of changes are underway, and I work very hard to get what's out there in here for you. Also, as I mentioned at the beginning of this video, check out this video here, which will help you decide whether you should take Social Security early or take it late. This is Jeff Schmidt. Thanks for watching.